Welcome to this explainer. I'm putting on my investment analyst hat today because we're diving into Five9's explosive Q1 2026 earnings report. And let me tell you, it's presenting a massive dilemma for investors right now. Look, Five9 is a major player in cloud-based contact center software, and they just dropped a quarter that literally has Wall Street split right down the middle. We're seeing a fundamental shift in their financials, and honestly, the market is having a really tough time pricing it in. So what are we looking at here? Is this a highly profitable AI-driven powerhouse? Or is there something hiding beneath the surface? Let's look under the hood together and let the data tell the story. Okay, here's our roadmap for today. First, we'll look at the profitability pivot. Then we'll break down the bull narrative, followed by the bear narrative. And finally, we'll tackle the valuation paradox. Let's jump right in. Section 1, the profitability pivot. Let's look at Q1 2026 by the numbers. Okay, you really have to see the sheer magnitude of the jump in GAAP net income here. Just look at that top row. They went from essentially just breaking even at $0.6 million in Q1 2025 to a very healthy $18.4 million in Q1 2026. I mean, that is a massive leap. And hey, it's not just some accounting magic either. Their non-GAAP net income climbed to $58.6 million, and their adjusted EBITDA margin expanded from 18.8% up to 24.4%. What this tells us as analysts is that they're getting significantly more efficient. They're actually converting more of their sales directly into cold, hard profit. And what's great is that on top of that profitability, revenue grew 9% year over year. That actually beat Wall Street's $300 million projection by pulling in $305.3 million for the quarter. So we aren't just seeing a company slash its cost to show a quick profit, they're actively growing their revenue base while simultaneously expanding those margins. You know, beating consensus estimates in this kind of macro environment, that is no small feat for sure. But the absolutely crucial point here is this figure. Five9's trailing 12-month net income now sits at a $57.3 million profit. That is a massive turnaround from a previous $12.8 million loss. When we look at a full 12-month window, it smooths out all that quarterly noise and shows us the broader trend, going from a nearly $13 million deficit to over $57 million in the green over just 1 year. Well, that's exactly the kind of fundamental shift that forces the market to completely reevaluate a company's story. Moving on to Section 2, the bull narrative. Let's focus on efficiency and AI growth. So the bulls are arguing this is now an earnings-driven story, fueled by booming AI demand and frankly, immense management confidence. That 42% growth in enterprise AI revenue, that's the crown jewel here. Contact centers are basically ground zero for AI disruption, and Five9 is clearly capitalizing on it. On top of that, management isn't just hoarding their cash, they're buying back their own stock aggressively. Think about it from an insider's perspective. You don't authorize a new $200 million buyback unless you truly believe your stock is severely undervalued. They also initiated a $90 million accelerated repurchase to finish up an old program, and to cap it all off, they actually raised their full-year revenue guidance to north of $1.25 billion. Now, to really understand their stability, we need to look at their economic moat, specifically their dollar-based retention rate of 105%. This basically means they're successfully extracting more value from their existing customer base without even factoring in new acquisitions. This is a vital health metric for any software-as-a-service business. Think about it. If Five9 stopped acquiring new customers tomorrow, their revenue from their current base would still grow by 5% just because existing clients are upgrading packages and adding seats. That is a fantastic foundation for sustainable growth. For the optimists out there, this historical earnings growth supports the narrative that Five9 can sustain cleaner margins and justify a higher market valuation. A nearly 38% average growth rate over half a decade? That proves this recent quarter isn't just a flash in the pan. The bulls see a company that has reached a critical mass of scale, where every new dollar of revenue disproportionately drops right to the bottom line. Okay, Section 3, the bear narrative. Let's flip the coin and look at slowing growth and insider selling. Bears are really quick to point out that despite all this AI product integration, Five9's projected 8.3% revenue growth is actually lagging behind the broader 11% US market average. This is a major sticking point, right? If you're a tech company riding the AI wave, the market generally expects you to be growing faster than the average business, not slower. This sub 10% growth rate makes skeptics wonder, is Five9 losing market share to competitors? Or is the transition to AI actually cannibalizing their legacy revenue faster than it's creating new revenue? Furthermore, skeptical investors, especially those applying a Peter Lynch-style analysis, highlight a couple of major red flags. Recent insider selling and a $16.2 million one-off loss dropping off the books make that headline profit swing look, well, a bit less organic. This is where beating the fine print really matters.
Remember that amazing $57.3 million turnaround we just talked about? Actually, scratch that. $16.2 million of that is simply because an old, one-time accounting loss fell out of the 12-month window. It's not all new operational cash flow. Add in the fact that company insiders have been actively selling shares over the last 3 months, and bears start to seriously question how durable this profitability really is.
And when we look at valuation, the PE ratio is not showing a clear discount compared to industry peers. So bears argue you're still paying a premium for a company whose top-line growth is slowing down. You're paying roughly 30 times earnings for Five9. Now, if they were growing at 20 or 30% a year, that might be a bargain. But with growth projected at just 8.3%, paying a premium over the industry average feels incredibly risky to conservative Benjamin Graham-style value investors.
Which brings us to Section 4, the valuation paradox. Are we looking at a bargain or a trap?
This is the ultimate clash between the raw data and market sentiment. Is the stock a bargain or a classic value trap? We have a highly profitable company with a loyal customer base and aggressive share buybacks, right? But it's saddled with slowing growth and insider selling. You really have to ask yourself how you weigh explosive margin improvements against market trailing growth. Are the bears completely missing the power of Five9's new operating leverage? Or are the bulls just ignoring a fundamental slowdown in the core business? And here's where the paradox really hits home. Despite all the bearish concerns, discounted cash flow models suggest the stock's fair value is actually more than double its current trading price. For context, a DCF model projects how much free cash flow a business will generate in the future and discounts it back to today's value. According to these fundamental models, Five9 should be trading near $55, yet it sits around $22. The market is effectively saying they just do not believe Five9 can actually deliver on those future cash flows. That is a massive, massive disconnect between the math and the market. Ultimately, what you should take away from this explainer is that Five9 is at a major crossroads. Will their aggressive share buybacks and AI growth prove the bears wrong, or is the market right to demand proof that this new profitability is actually here to stay? Look, they've proven they can turn a profit, but now they have to prove they can sustain it while re-accelerating their top-line revenue. So looking at all these numbers, the final question I'll leave you with today is this. In a market utterly obsessed with AI, is Five9 the most overlooked bargain in software, or are the numbers hiding a structural slowdown? Thank you so much for joining me for this explainer, and as always, keep questioning the data.